Ross, I'll go to you first. What stood out to you as a shareholder? What do you like?
I like that 30,000 people every day are signing up for Netflix, and that looks to continue even with higher prices coming. The content just gets better and better, it seems, every year, and people don't watch TV anymore. They watch Netflix. So, I've never seen a company with such a big, revenue base grow so fast for so long and continues to do this on a global scale. So I think we have a lot more to come with Netflix over the next several years, and I'm very excited for the future.
But do you need to keep seeing that growth, Ross, if it's going to justify the valuation? I mean, if it petered out even slightly, you'd see a big move down, would you not, in the share price?
Yeah, we in our investment meeting this morning, we were talking about Netflix, and, it's got 110 PE, and that's basically an arbitrary number. It's sort of the voting mechanism that investors love Netflix. And, it's been a top-performing stock for years. But, if the PE was 50, you could still argue it was overvalued, and if the PE was 150. So, the stock is basically trading off sentiment towards the company, but I just don't see that changing, and their earnings will grow and grow too.
Matthew Harrington, one thing that people are pulling out has to do with the cash burn. It was down, $3 billion this year. They project same next year, and then it looks like it's going to start to get better. Is that reassuring enough to investors that are looking for some sort of turn in profitability?
Well, one thing that we called out is that you had a material, 13 to 18% price increase, and you're not really seeing any diminution in the cash burn this year, which really tells you that they're channeling even more of the sales receipts in the new programming in anticipation of the heightened competition. So I think that they're trying to be agile, creating a lot of new programming, and I think that makes a lot of sense. In terms of the numbers on Q4, the paid numbers of 8.8 was actually up versus the 6.6 in Q4 2017. So I thought that was extremely encouraging. I think you've got a huge global total addressable market here, and overall I'm relatively pleased. But this trades on animal spirits. We try not to fall in love with it. We had a buy on it earlier this year. We had a sell on it until about 2 months ago. And I think this is a great long-term story, but it will certainly require some patience along the way.
And Matthew, do you think that the company's free cash flow burn guidance for this year and next year, beyond and all that, fits with what investors were already thinking about?
I think it absolutely does, apart from you could have made an argument when you had that material, a price increase, you might have tweaked the free cash flow burn that they were talking about earlier in the year. But of course, they're holding it constant, which tells you that you're spending, even the delta on the programming spend is increasing a little bit more as well.
Tom, some fascinating statistics they put in there about one of their new foreign programs, Elite, and the growth in media, in social media following that the stars have got just from the recent release of that show. Is that something that's important for them long term in terms of continuing to attract the best talent to the platform?
Yeah,
absolutely.
I mean, this is.
Sorry, Tom.
Sorry. Yeah, sure. I mean, this is a company that is trying to internationalize its programming. They want to make shows that have appeal in the U.S. and around the world. So anytime that they can show, especially, a foreign language or a foreign-based program that has some measure of success and cultural significance outside of that one region, that kind of is a proof of their concept that this is an international entertainment programming service. So that's what they're going to be pushing for all the time. I mean, earlier you mentioned Roma, which is kind of their big Oscar movie this year. That's a foreign language film that's doing well in the U.S., and they want to see a lot more of that as much as possible to prove that this is really an international service.
So, Ross, competition, always an issue. I like how Netflix, Reed Hastings in his letter to shareholders goes directly to that, talks about Fortnite, for instance, and how they did well for a few minutes when YouTube was down, not worried about Disney+. How as an investor, as a shareholder, do you think about those looming threats?
Well, yeah, time is limited in life. We get 24 hours a day, and video games are a legitimate competitor. And I found it incredibly interesting that that's what he said, because I actually do think that's the competitor to Netflix. And it is video games, because that's what I play when I'm not watching Netflix, is video games, not watch other services per se. I think Netflix also has some levers they're not talking about as much. They mentioned in the earnings report, which is putting these movies in the theaters. They're coming out with a movie called The Irishman, which would easily do $100 million in the theaters if they launch it. And I think that what they're going to learn is that by putting their good movies out in the theaters, maybe a month before release on Netflix, nobody on Netflix is going to care, but they could rake in, hundreds of millions, if not billions of dollars in the future from that same content if they leverage it like Disney does. We think Disney competition is not really going to hurt Netflix as much as actually hurt cable companies more. Because I think ultimately everybody will have Disney and Netflix. So I see video games is Netflix's competition. But in reality, when people sit down to watch a show, they're watching Netflix. So we're not concerned at all about that.